Nikki's chair. Just so everyone knows, we're going to wait just a moment here, let a few more folks get on, and then we'll get started with introductions and all those things. So hopefully everybody is on their way in. It looks like we're about 30 people so far, so we're short a few. We'll pause for a few minutes and just make sure we're hopefully all in here. Well, we're creeping up in numbers, but I think what we'll do is go ahead and get started. I know you two have a lot to tell us, so I'm going to do a very brief introduction. My name is Dan. I am the president of the NoCo HBA this year, chairman of the board, technically, I suppose. And today we have John Covert, who is with Zonda. They are formerly Metro Study. He's got a lot of information for us. And our first speaker today will be Robert Dietz. He is the NAHB's chief economist. So welcome to both of you. And I'll let you guys jump in and tell us all we need to know. Thank you.
Great. Thank you, Dan, and thank you to Nikki and the HBA staff. It's good to join you all. Wish it was obviously in person. That would be a lot more effective. But, this is kind of way things have been. And I think by the time we roll around to the spring of 2021, we're going to get back to normal. We certainly got some good news on the vaccine front. And if we're looking at good news in this environment, housing's definitely been the bright spot of what is a recovering economy. Despite government actions, and whether they're effective or not, but government actions intended to fight the virus, the housing market really has persevered. And there's a lot of reasons for that: low interest rates, favorable demographics. So I'm going to walk you through our current economic outlook before turning it over to John. And if we're thinking about the broader economic picture, we've been looking at what we've called three historic data cycles. One is the builder confidence on the NAHB Wells Fargo HMI is at a level of 90. That's an all-time high. The prices of resale housing continue to go up because of a lack of inventory, so much so that the typical resale home and the typical newly built home on a nationwide basis have almost the same price. And that's a real kind of historic indicator of underlying housing demand. And we have a huge gap between new home sales and current production, which indicates two things. New home sales are likely to have some choppy conditions as sales slow a little bit to catch up with construction. And construction should continue because there's a lot of backlog out there. Obviously, we've suffered through a number of supply chain issues. I've got some good news for you on lumber. We're obviously tracking the fact that it's taking longer. It's more expensive to get other kinds of building material products, and that is going to lengthen construction times as we move forward. But as I said at the beginning, demand is growing. It's in part due to what we've been calling the suburban shift. I've got some maps for you on that. The work at home trend, historically low interest rates, and favorable demographics. So let's start off with the GDP data. This is for the Fort Collins MSA. And you can see here, growth rates, 4 to 5%. This goes up through 2018. We don't have 2019 data yet. This is calculated with a lag, but this has been an area obviously growing a lot faster than the rest of the country, and that's a good place to be as we went into a downturn. And here is that downturn. You can see the economy kind of rolling along since 2014. Actually, growth picked up after some of the tax reform efforts. And then we hit 2019, we have a decline in the first quarter, a historic decline in the second quarter, the worst GDP quarter that we've had since World War II, and then a really strong rebound. And yes, I know there's a debate among economists on whether we have a V-shaped recovery or a K-shaped recovery. I would put myself in the V-shaped class. K-shaped is partly political. It's the idea of that there are some people who are doing worse. It's true that not everyone's recovering as fast, but I'm not necessarily convinced that there's a group that's progressively doing worse and worse and worse. It's just a matter of the recovery speed. What you can see in the third quarter is that markets were ready to respond and recover. Now, how long is that full recovery going to take? Probably about 2 years. And if you look at our annual numbers in 2020, we think the overall size of the economy is going to end up being down by about 3.6%. And then in 21 and 22, we start to grow again on a net basis. It's not going to fully recover in 2021. And something that we have changed in recent weeks, we did downgrade our forecast just a little bit because we are concerned about growth and regulatory policy with the change in the White House. And that could slow some business activity. But you can see we've got growth accelerating in our forecast window, and that's really just a story about the vaccine. As the vaccine is deployed, those parts of the economy that have been shut down will begin to heal at a faster rate. And when we were looking at the macro data, we looked at some points to say, what are some good analogies of what the economy is going through, and what can we learn from them in terms of housing? And a good one was restaurant sales and grocery store sales. You can see fairly stable growth. In fact, restaurant sales get ahead nationwide of grocery store sales in 2015. And then we hit 2020, and what happens? 50% decline in restaurant sales as people stop going out, and a big surge in grocery store sales during those weeks in March and April where it seemed like some of the grocery store shelves were empty. And so this is a good analogy of a sudden disruption and then some persistent effects after the vaccine. So we can see markets beginning to heal. Restaurant sales have recovered as the economy is reopened. That's likely to get a little shaky as we go through the fourth quarter and the first quarter next year. And you can see grocery stores coming back down. So there's permanent effects, the fact that the lines have crossed, and then there were temporary effects, the big shifts that occurred early on in the virus crisis. And I think that is a good analogy for what the economy is going through. And if we look at it at its broadest level, we can see the impacts. Services are down. Yes, they kind of got a small V-shaped recovery, but they're lower than where they were. And this is because travel and tourism and hospitality sectors are down. The goods part of the economy, which includes much of the housing market, is actually higher. So, this shift, this substitution effect, and those substitution effects are what's driving some of the strength in housing, that economic activity that used to occur in the non-residential commercial real estate sector is now occurring in our homes. And that's helping the remodeling sector and the building sector. And you can see the green line here is structures. That's really being driven down by multifamily and by non-residential construction, which at the very end I'll show you is basically in for a multi-year recovery process. In terms of the labor market, we've got a 6.9% unemployment rate. Again, if you look for a quick recovery, it's there on the red line. I think when we look back, we'll end up seeing, after we revise the data, that the unemployment rate topped out at around 16 or 17%, and it came up really quickly, and it came down fairly quickly. So the economy was in really solid shape before we went through the virus crisis. Unfortunately, we do think the recovery in the labor market at this point is going to be slower than what we've experienced, say, over the summer as the economy reopens. So we think that, the unemployment rate is going to get to 6 to 5%, but it's going to take a couple of years going forward for that recovery to occur. And then in terms of local job data, in September, the Fort Collins MSA was down 7% in terms of net job losses. Recovering, but recovering slowly, and the state as a whole down 5%. The recovery at the state level is actually a little bit faster than what we see in the local data in terms of returning jobs after those disruption effects that took hold in the second quarter of 2020. And any discussion about the labor market, particularly given the fact that we've got a labor shortage that's ongoing in the construction industry, has to note that some of the damage that's been done to the labor market is in what we call the labor force participation rate. And this is the share of the adult population that either holds a job or is looking for a job. You can see it took a big decline. It's recovered a little bit. It's come to from basically 63% to 61%. And unfortunately, part of that decline in the labor force participation rate, it's mostly concentrated among women, and it has a lot to do with the fact that schools in many parts of the country did not reopen. And so when that happens, particularly in a two-spouse household, somebody often has to stay home and watch the kids, and that's holding the labor force participation rate down. And it is a challenging factor to get the healing in the labor market. So getting the schools reopened, I really think, is a big part of recovering from the virus crisis. So if we take a step back then with all those macro factors, what do we think about interest rates? The 10-year treasury really is the most important financial variable you can track. We're at historically low rates. It's ticking up a little bit, near 0.9% today. We do think the 10-year treasury rate is going to go up over the next couple of quarters, and particularly as we get further down the road on a vaccine. Because as a vaccine is deployed, growth for the overall economy is going to step up. And when that growth goes up, the expectations for growth increase, interest rates tend to go up. And a good example of that, you can see it on this slide, is 2013. That's back during the taper tantrum, when the Federal Reserve said they were going to pull back on quantitative easing. And we had an 80 basis point increase in the 10-year treasury, and it did push up mortgage interest rates, which are marked in red here. So if you're looking for a kind of a stop-start type process, be on the look for the virus news, because that is likely to move interest rates. The good news is our forecast, we do have interest rates going higher, but going higher slowly. So we think, for example, over the next 2 years, the 30-year fixed rate mortgage will remain below 4%. So it's going to go up. It is going to take away some of the momentum on the sales side, but generally speaking, it should remain near these historic lows, and that should be good for housing demand on the existing side of the market and the newly built home side. The fundamental driver of rental and for sale housing demand is obviously population growth. Here is an area where Fort Collins just excels compared to much of the country. Yes, the growth rates are lower than what we saw in, say, 2014. The population growth rates in 2019, 1.8%, very strong. Colorado itself, 1.2%. And these are rates of population growth that are 2 to 3 times the country as a whole. And you rarely see this in the United States. It's limited to places like northern Colorado, some limited parts of Florida and Texas. And there are many parts of the country where population growth is actually flat. And then looking within the Fort Collins area, this is something we discussed at the Housing Summit last year, but it's worth noting in the 2019 data, there's a big divide between those two counties, Weld showing a 3.1% growth rate and growing faster than the area as a whole. So there are distinct pockets of strength within the market. And of course, those distinct pockets of growth, whether it's locally or nationwide, have impacts on the homeownership rate. Red is bad on this map. Those are areas where you've got a lower level of homeownership. California is a good example where it's so expensive to build, it is difficult for particularly younger households to achieve homeownership, and the results are ever declining homeownership rates. So the homeownership rates locally are not bad. 65% for Lair, almost 73% for Weld. These are generally relatively high, particularly the area for Weld, but there's something to protect. And that's an area where watching regulatory policy at the local level, impact fees, other kinds of costs of development are key to make sure that those homeownership rates stay relatively high. Turning to the supply side, I think lumber really has been the most important challenge on the supply side of the market. You can see here on the blue line the roller coaster ride that we went on lumber prices in 2020. I mean, from mid-April to about mid-September, prices were up more than 170%. And there's really no kind of rational economic explanation other than some mismatches between demand production and the lingering effects of the Canadian tariffs. And I said I have some good news. That good news comes in two parts. One, prices have come down a lot since mid-September. We think they're kind of leveling off here in the mid-500s, and the futures markets suggest that that's where we should be on a per thousand board feet measure. But the other bit of good news is that the Trump administration has announced a reduction in the effective tariff rate from 20% to 9%. So basically the tariff rates getting cut in half, and that should help support lumber. We want more domestic lumber production. My concern is that increases in regulatory policy in the Biden administration will make that more difficult to achieve. But that's something that we're certainly watching at the NAHB level, certainly state and local associations advocating for the industry to make sure there's a available supply of lumber so we can build houses. I mentioned the labor shortage. It does continue. The red line here is a intensity measure of the labor shortage. And you can see in late 2019, it was getting a little bit better, but still well elevated from where it was in 2006 and 2007. We're short more than 250,000 workers in the construction industry. And this is really a moment to go all in and bring people in from other sectors that are experiencing job losses and bring them into the construction industry. And of course, this is always a supply side issue, regulatory costs. This is a 2016 study we did. We found that about 24% of the price of a typical newly built home was due to regulatory burdens. And we do this study every 5 years. So the first one was in 2011, and the next edition will be done in 2021. So certainly we'll be publishing that and presenting it to the Biden administration and to other policymakers across the country when we get the new results. But 2/3 of that impact is at the land development side. And when we hear in surveys that the land and lots are in tight supply, certainly regulatory policy is one of the factors that's limiting that part of the home building production pipeline. All right, so now if we put it all together, I'll walk you through our actual forecast. Now, in the historic data signals, I mentioned the fact that with the largest ever gap between new home sales nationwide and the production of for sale single family housing. The blue line on this slide is something that we constructed. It actually took a fair amount of statistical work from census data because you can't pull this off a line item. But basically, you've got an apples to apples comparison on the slide. They're measuring the same thing, which is for sale single family housing. You can see the two lines generally move together, and that red line and the blue line right now, the largest ever gap. So there's a lot of builders who are signing sales contracts with home buyers for homes that haven't even started construction yet. And in fact, in the October census data, the count of homes that were sold that had not started construction was up 100% compared to October of 2019. So this is our reasoning in terms of the forecast of thinking that we should see some slowdown in new home sales at an aggregate level and catch up in single family starts in order to close this gap. And I think this is a really important data signal that's generally speaking bullish, but also indicates some of the challenges in the production pipeline. And as I mentioned, a historic data signal, builder confidence. This is our flagship survey. If you participate, I thank you. If you don't, you can reach out to us and join the HMI panel. I would love you to do so. We're at a level of 90 on a 100-point scale. That's the highest ever in this index that goes back to 1985. And it moves with the red line, which is a measure of single family construction. And it's a real bullish signal that we should, at least according to builders in our survey, we should continue to see production gains for single family construction going forward. Again, in the survey, lots of buyer traffic being supported by low interest rates and a shifting geography of home buying demand. So here's our forecast. And we're deliberately conservative when we come to our forecast. In part, that's due to the lessons that we saw coming out of the Great Recession. And what we think the story is here, and the blue line is national single family starts. You can see the disruption effect, the decline that took place in early 2020 in terms of single family starts, a very strong rebound. And we think that rebound will continue to rise somewhat as we catch up for those sales that have been signed that haven't started construction. And then there's going to be some choppy conditions where we get back to the long-term trend line that effectively we've been on since 2011. So we think for 2020, we're going to end the year about 9% higher, just under 970,000 single-family starts. And then 2021 and 2022, we should see modest single-family construction growth moving along the trend line. And we think ultimately nationwide, we're going to end up producing about 1.1 to 1.2 million single family homes as we grow our labor force, as we bring more lots and land into the production pipelines. I will say right now, there's probably more upside risk to our forecast. In other words, we're probably a little bit too low on 21 and 22, but we're staying conservative just because of the uncertainty related to vaccine and the public response to it, and the impacts that would then have on the labor market. In terms of local data, in terms of single family permits, Fort Collins MSA right now is up 47% compared to where it was a year ago. If you look at the early months of 2019, these are fantastic numbers. You don't see this kind of growth elsewhere in the country. And so it's again, a real bullish sign locally. And I do think just like nationwide, you're going to see the growth rate slow, but ongoing gains for single family construction locally. And a trend, we do think that new home size, which has been falling for the typical newly built home for the last 4 or 5 years, that's going to end. And you can start to see this on this slide. The new home size appears to be leveling off in 2020. And everything in our surveys suggests that new home size should begin to rise. People are using their homes for more purposes. And in the buyer surveys, we're seeing clear evidence that they want more space. And we hear this from remodelers as well, and from multifamily apartment developers. So this data series is likely going to level off and then begin to increase, and will increase through 2021, which is good news for everyone in the industry because it means each home is going to have a larger economic impact in terms of job creation. And I've mentioned this a couple of times, but the geography of housing demand really is shifting. And we're calling this the suburban shift. It's not an exodus, although it is affecting cities like New York and San Francisco greatly. But when we look at the building data, this is data that we just published today, in the third quarter, using our home building geography index, what we find is the growth rates are the strongest in lower density, lower cost markets. So for example, the counties you're looking at here are all the large metro core counties in the United States. They represent about 17% of construction. And over the last 4 quarters, they averaged about a 5.7% growth rate. Now, if we take a step out to the suburbs of those areas, you can see the growth rate grows. So lower density, and the growth rate's up to about 11% on average across this suburban geographic tracking. And if we take another step out to small metro core counties, which includes parts of your area, up to a 12% growth rate. So lower density markets growing faster than these large metros. And in fact, the fastest growing area that we track in the geography index, which are suburbs of small metros, actually up 15% on average through the third quarter. So, clear suburban shift in terms of where single family construction is taking place. And we did a special cut of this data on just second home markets. So these are counties in the US that have at least 15% of their housing stock being vacation homes. And in the third quarter, these areas were actually up year over year, 23%. So it's not just that, growth is moving out to some of these suburbs. We are seeing an actual delta, actual growth change in some of these traditional seasonal residence markets, maybe as baby boomers begin to shift to retirement, or people in some cases actually work remotely. And it's helping the second home market. And oh, by the way, it's not just single family, it's multifamily construction as well. The map in front of you here is the exurbs, small metros, rural markets, small towns. They represent only a third of construction of multifamily, 2/3 are in the counties in white, but these areas are growing faster than the counties in white, which are the large metros. So it's single family construction, it's multifamily construction, it's second home construction. They are all growing faster and lower density, lower cost markets. And we think those changes are being accelerated by the virus. Here's the local multifamily data. Data is very noisy, so we tend not to forecast this. But I think, generally speaking, if you got more population growth, these areas should continue to see, on a trend basis, gains for multifamily permits at the statewide level and the MSA level in terms of apartment development going forward. And here's our national forecast in terms of apartment development. 2020, we think we're going to be down about 4%. And then we've got stronger weakness in 2021. Nationwide, we'll see the apartment development market be down about 14%. Permits are already down by double digits, so it's already forecasting this kind of decline. But we think based on demographics and in healing, improving labor market, that 2022 should see stabilization in terms of apartment development. And keep in mind, a lot of that pain is being concentrated in the hyper-dense, high-cost markets. We're seeing gains in garden-style apartments, low-rise multifamily, particularly in those lower density markets that I mentioned earlier. And then remodeling, we expect about 6% gain in 2020 when the data are all in. And in fact, 2021 and 2022, growth in remodeling should continue, particularly as we see solid numbers in the resale market and the fact that people are using their homes for more purposes. And so there's more demand for improving their homes, adding additions, making those changes as people recognize the importance of home due to the virus crisis. And then just to wrap everything before I turn it over to John, if we think about the contrast of this recession, the recession of 2021 that we did not predict certainly last year, probably as late as early February, we were not predicting a recession, and how serious the virus crisis really turned out to be. But the contrast is really clear in terms of residential investment versus non-residential construction. So the blue line here is residential fixed investment home building. You can see the V-shaped recovery there. A decline, a recovery, in fact, on some parts of the market, if we exclude everything but apartments, we're actually stronger now than we were at the start of the year. In contrast, the red line is non-residential construction, and the output gap, in other words, the amount of time it'll take for non-residential construction to get back to the volume of activity that it had at the start of 2020, could be 4 to 5 years absent a big infrastructure bill. And because of that, we see weakness in office spending, retail construction. There could be some rehab type of efforts, but generally speaking, it's housing that's a bright spot in this particular market. We're seeing broad weakness in other parts of the commercial real estate market. And that message that we're going to carry in Washington, D.C. through NAHB and your membership, which is that housing is a job creator. We've got a lot of momentum. We've got some challenges ahead, but generally speaking, housing is that bright spot, and we really need to foster that as we move into the marketplace. And so I want to thank you very much. My Twitter address is on here at @Dietz_econ. ionhousing.org is our economics blog. You can find most of the data that I walk you through here. And with that, I'm going to stop sharing my screen, and I will turn it over to John Covert from Zonda.
Thank you, Robert. That was excellent. I've listened to Robert present many, many times, as I know most of you probably have, and he does such a great job representing the industry and presenting the information. So let me share my screen here so I can talk a little bit more about what's happening in the local markets. And I also want to say thanks to you, Dan and Nikki and the HBA team to the invitation once again to present in front of the group. Wish we were all face to face, but that's the reality of the situation that we're all in. And I got to give a little disclaimer on that note. I am presenting from the loft of my home, as you can see. My wife, who's a kindergarten teacher, and I think Robert accurately depicted the challenges that many of us face. She is teaching virtually from home today. She's a Jefferson County teacher. Can't imagine how you teach kindergartners most of the day, but she is doing that. So if you hear in the background some singing or crying, that's what's happening. As my wife is currently, I can hear her in the background teaching these kindergartners. So hats off to the parents that have to try to navigate working from home while their kids, especially young kids in the primary grades, are faced with the challenges of learning virtually. Really, really difficult on families and everybody involved. So having said that, let me dive into a little bit about what's happening in Northern Colorado specifically. And for those of you that aren't familiar with our formerly named company, Metro Study, or even Myers Advisory, we're now rebranded as Zonda. And that's one of the names of our primary user interface applications, but we basically go out and survey the market both on a quarterly basis, where we actually go visit every new home community and look at every house and every lot by doing a windshield survey. So we're assessing all of the future lots moving through the pipeline. We actually catalog all of the recorded plats moving through the entitlement process, all the conceptual lots that are in the pipeline as well. So we had a good understanding of the future pipeline, but we also have a good understanding of how many finished lots are in the market. So we count the number of vacant developed lots, then the number of housing starts, number of completed homes, and then number of move-ins and deliveries as well. So we're tracking starts, closings, housing inventory. So we do that every quarter, and we're just now starting our fourth quarter survey. But we also do a sales survey. So we interview all the sales offices every month, and we do a weekly traffic survey as well as sales contract survey of many of our participating builders to get a sense of the demand that's actually out there, sort of real-time demand that's out there that they're cycling through the sales offices. So we really have been able to kind of triangulate all of the demand and the supply side of the data that's out there. And that's what I'm going to kind of walk you through our observations today. So before I do that, and I think Robert hit on this several times accurately so, and I couldn't agree with him more of his overall assessment of what's happening in the national marketplace as well as what's happening here locally, as he touched on. But to me, everything is sort of overridden by the current status of the pandemic. As we all know, that our status dial was revised a couple of weeks ago to include this extreme risk, or this purple category. And you can see that the majority of the Front Range of Colorado and some of our mountain communities have hit that severe risk red scenario or status in our dials, where we're just teetering on the brink of that extreme risk and shutting down because our caseload has really accelerated over the past month or so. So all bets are off. I think as it relates to the short-term impact on housing, we've gotten a glimpse of this, of course, when we shut down locally with our stay-at-home orders back at the end of March through April, as most of the country did, about the immediate impact to home building. So our cases are obviously more frequent, more severe. The hospitals are, I think, grappling with this pretty well, particularly in northern Colorado, as some of you have heard in previous presentations, with healthcare officials in northern Colorado talking about the capacity for the hospitals, and they're managing it pretty well so far. But the caseload continues to go up. In fact, this is a little dated information. I was looking at it this morning, but didn't update the slide. It's starting to level off just a little bit and maybe even decline a little bit, but still, these are pretty alarming trends, and it has a direct impact on locally what happens with the home building industry. We know that our industry is an essential business, and it'll continue to keep moving. And I'll cycle back around to some of Robert's comments about the gap that we're seeing between sales contracts written and prior to a home starting. So that is absolutely happening here locally, up and down the Front Range, where demand remains very strong and the builders have really healthy backlogs. So even if we go back to shutting down again or stay-at-home orders like we did in the spring, for the short term, builders have substantial backlog like we did in December, January, February of this year that kind of led us through the early wave of that stay-at-home order. So we may be able to still navigate that and still keep homes getting built as we wait for the impacts of the vaccine to occur. But again, for me, locally anyway, and I think for a lot of the builders that we've been talking to throughout this whole crisis, this is the overriding issue that we're all facing. So anyway, I'm not going to spend a whole lot of more time on that because I know you probably have pandemic fatigue when it comes to understanding how it impacts our local lives. But I thought I'd start there. And then Robert talked a little bit about what's happening in the local economy. I'll provide a couple of additional slides here just so you can see with a little bit more granularity about what's happening in our larger sectors when it comes to where the reductions in our workforce primarily took place. One of the things, so you can see there, as of September, we're still down about 16,800 jobs compared to where we were September of last year. That's an annual growth rate of minus 5.8%. And as Robert indicated, Northern Colorado in particular, Larimer and Weld County have been incredibly strong, robust local economies, has grown at a faster rate even than the Denver metro area economy. And that's been the case for the last couple of years. Growth has really accelerated here. So the underlying strength of our local economy is, I think, really what's carried us through the initial shock wave that we've gone through with this pandemic. And I did a little back of the napkin math. I know Robert does this as well. But if you took over the last 10 years, our annual job growth in Northern Colorado combined, Larimer and Weld County combined, we averaged about 8,200 net new jobs on average the previous 10 years. So we've been on a long growth recovery after the Great Recession. So if I took that monthly average of about 700 jobs created a month just on the previous 10 years growth rate, it's not going to function this way, but it's kind of the way my head was like, okay, if we just created what we had in the past, moving forward, adding 700 jobs a month to Northern Colorado's economy, we wouldn't reach our previous peak employment, which we saw February of this year, until late 2022. And I think that speaks to what Robert was talking about nationally. It's going to be a longer, slower recovery than it was the rapid decline that we experienced this spring. And on the right side of the graphic here, you can see that the differences in the makeup of our local economies, I think, indicate how the local economies recover coming out of this. Higher concentration of jobs, for example, in Larimer County, this leisure and hospitality sector, 63% of all of the Northern Colorado jobs in that sector are in Larimer County. So obviously it got hit a little bit worse with the pandemic shutdown, which had a particular harder impact, particularly harder impact on the leisure and hospitality sectors, as we all know. Weld County, the only two sectors where they have more jobs as a percent share in Northern Colorado than Larimer County does, is that natural resources and construction sector. That obviously, intuitively, everybody knows that because it's so heavily tied to oil and gas, a lot of warehousing, distribution jobs there as well. And the other one is manufacturing. You can see it's sort of 50-50, about 48% of the jobs total in Northern Colorado are tied to Weld County in that manufacturing sector. So those industries have been impacted as well in Northern Colorado. And you can see when you separate out all of those industries, just year over year job growth as of September, what Weld County has done, which are in the blue, versus Larimer County in the gray. And as I mentioned a little bit earlier, the leisure and hospitality sector in the gray, you can see it was hardest hit in Larimer County because there were more restaurants, more hotels, for example, than Weld County. So the heavier burden of that job loss really fell on Larimer County. Whereas the natural resource and construction sector, which Weld County has the majority of those jobs, was particularly hit, still 8.2% down from the previous year. So you can see the economic recovery is going to look a little different based on the job mix for both of those counties in Northern Colorado. And, I think it stands to reason that a couple of years from now, when we look back, the mix of our job, our total employment base is just going to look different. We know that a lot of these restaurants will probably never come back. And some of these other smaller businesses may never come back. So as Robert indicated, we may have to get people to think about different industries and retrain people to get into different types of industries and jobs as we go forward. Because it's not going to snap back the exact same way that it was before. And I think this next slide shows you that Larimer and Weld County have actually recovered in the later stages of this pandemic a lot faster and more different than the metro area, Colorado Springs, the entire Front Range, and all of Colorado for that matter. And you can see in September, the unemployment rate for Fort Collins and Greeley, the MSAs, again, are generally lower than the rest of the Front Range. So I think that speaks to, again, to the underlying economic strength of our local economies before heading into this pandemic are proving beneficial coming out of this as well. A little bit about the resale market. It's really incredible what's happening here. You know, whether you're talking to brokers in the local community or especially builders that we deal with mostly, you know, standing here at the end of March, 1st of April, there's nobody, there's not one person that thought that we would be standing here at the end of the year with the kind of sales volume, sales prices, housing starts that have been achieved for 2020. Most of our builders, particularly in Northern Colorado, have told us that not only are they doing better than they were last year this time, that they have set actual records for housing production in 2020. I mean, shocking compared to where we thought we were going to be headed at the end of April. So the resale activity, I think, is indicative of that same sentiment. You can see that year-to-date sales are up 6% as of September, and that's despite the big drop that we had in April and May. So no secret there, but I think what is really pushing some of this pent-up demand that we had in the new home market is because the total listings and the resale months of supply has gone so low to record lows. And this is not a unique phenomenon that's occurring here in Northern Colorado. We're seeing this up and down the Front Range of Colorado and throughout the country as well, as I know Robert can speak to. But you can see 1.5 months of supply of resale listings in Northern Colorado. So for those people that came out of this initial shockwave of the pandemic, you know, we sort of stuck our finger in that hole in the dam to kind of shut everything down in late March and 1st of April, took our finger out, and we were really surprised how much water was gushing out from behind that dam. We just didn't know how deep that water was behind the dam in the initial months coming out of this, but it's been pretty long and sustained about all this pent up demand. And I think people are just having difficulty finding existing homes. And I think there's a lot of fear out there, at least initially, for people that maybe were reluctant to put their home on the market. They didn't want people walking through their homes, or they decided there's a lot of economic uncertainty out there. I'm just going to delay putting my home on the marketplace. For whatever reason, months of supply of inventory dropped dramatically on the existing home market. And I think that pushed a lot of people to the new home market. So of course, as inventory dropped, prices went up, and you can see the median resale price in all of Northern Colorado, this is Larimer and Weld combined, went up about 9% over the year. So I expect listings are going to stay really low for the foreseeable future, as low as they are right now, which will keep pricing pressure up and options low, and is probably going to continue to shift the mind share of the buyer over to the new home side. So that's really good for the home building industry. But do we have the capacity to deliver more homes? I think that's questionable, and we'll get into that here in a little bit. So as we add in the resale market transactions, which are the gray bars that you see here, the new home transactions, or these are the closings in the blue, and the orange triangles or diamonds that you see there are the percent share of new home transactions in Northern Colorado. So if you think back to pre-Great Recession, Northern Colorado was averaging somewhere between 25 and 30% of all transactions were tied to the new home market. Dropped obviously very low during the Great Recession. It's been, you know, a 10-year climb back out. So it's now about 26% of all transactions, we actually think in the year ahead, for the reasons that I just walked you through, that this is going to continue to accelerate back up to 30% by the time we hit 2022, and continue even to go up, because I expect resale inventory to stay very tight. And we have the ability to obviously add housing stock on the new home side. So this is a really good news for home builders, but again, it's a capacity issue. It's a cost issue for potential home buyers. But let's focus a little bit on, I also want to talk about one of the other major challenges here. I'm certainly not an oil and gas expert, but I do talk about this periodically, because it is such a large component of particularly Weld County's economy. The spot price of oil, the West Texas crude spot price of oil, obviously went negative. Remember that 1 or 2 days when it went negative territory, and now it's bounced back up to, I haven't checked what it is recently here in the last month or so, but it's, hovering at that $40 a barrel, which makes it really challenging for the basin that Weld County sits to extract a lot of profit out of that production. But the rig count for drilling new wells has obviously dropped down to extremely low levels. So there's not a lot of new drilling that's occurring in northern Colorado. And you can see the bottom left-hand chart, the total oil production in Colorado, over 90% of which comes out of Weld County directly. And Colorado now is a top 5 state for oil and gas production. So that's basically Weld County is probably a top 5 or top 6 for all of the nation in terms of oil production. You can see has leveled off, and that will likely decline especially as the regulatory pressure is increasing in the state of Colorado. We all know that setback rules are going to be extended from 500 feet to a couple thousand feet unless there's variance that's issued. So it's going to make it more and more challenging to get as many permits and as much production out of Weld County oil and gas. And so it'll be interesting to see, again, how that impacts housing in terms of job creation for the oil and gas industry, in terms of tax revenue for the counties, and tax revenue that gets actually pushed down to the school districts as well. So oil production, it's a little bit of an unknown what happens here with oil and gas in northern Colorado, but that's a big question mark going forward in terms of demand, which obviously was suppressed here during the pandemic, but also from a regulatory standpoint. Okay, so that's enough about the local economy. Let's get into our housing data for the next 10 or 15 minutes that we collect. And as I mentioned, we basically do our quarterly survey up and down the 11 county Front Range region for housing starts. So we're looking at annual starts here at the end of the third quarter. So these are new foundations put in the ground from our previous quarter survey when there was a vacant developed lot there. But this is a rolling 12-month look at the annual starts pace. So you can see that for those of you that have some familiarity with the Denver metro area and Colorado Springs, each one of these counties is moving a little bit differently. If you looked at Broomfield County, Jefferson County, Boulder County, City County, Denver, these are kind of our interior kind of core urban areas within the Denver metro area that Robert was talking about, kind of on a national scale. You can see obviously a pretty dramatic decline over the last 12 months. And some of this was already happening. We've been tracking kind of this shift out into the suburban ring in the Denver metro area and pushing down into El Paso County and Colorado Springs and up into northern Colorado, in part because of capacity for growth. There's just not a lot of land left in these urban core areas. So it was already kind of transitioning that way. And some of it was cost, pushing more buyers out of the Denver metro area up into, let's say, Southwest Weld County or down into El Paso County. So we're seeing more of that already, but just certainly accelerated this. And there's a couple of reasons why Weld County is down 6% for housing starts annually, and Larimer County is up 21% annually. Weld County has seen big jumps in the last couple of years, particularly that Southwest Weld County market and Windsor in particular. in terms of housing production. But this is just really kind of Weld County. If I added up all of these projects, a little bit of gapping, big projects that have been really successful have kind of run out of lots, and they're sort of waiting for their next phases to come online. And that's why we see a 6% drop. But we think that's actually going to come back at a pretty quick pace once these new lot deliveries take place and the home builders can get started putting the shovels in the ground again to put foundations down. And then Larimer County, I think one of the reasons why they've had a big jump, there's a couple of reasons. There's new projects that have been very successful that have replaced some older communities that have winding down. A couple in particular, like Copper Ridge, Mountain's Edge, Vantage, Saratoga Falls, Thompson River Ranch, Sage Meadows, Mosaic. These are all sort of Fort Collins, Loveland, up in Wellington, Berthoud as well. So they're kind of spread out. But I think the other thing that's worth noting, aside from a couple of those really successful projects, is that Larimer County has more attached product. So we're seeing more townhomes, a couple of little condo projects, but in particular, it's townhome duplex projects that have really accelerated. And I think that's in part because Larimer County's single family detached home price has gotten very high. So we've started to see the introduction of more attached product in this market. And I expect that that's going to continue to go forward. Okay, so let's combine Larimer and Weld County into some kind of macro numbers here. And I broke out, so you can see this on the left-hand side. There was this 10-year time period, again, coming out of the Great Recession, where we've seen pretty steady housing production. So we've just now peaked at over 5,000 annual starts for Larimer and Weld combined. And you can see our annual closings are right behind it at about 5,000 closings. So the reason why I think that's notable is that, you know, generally in a rising market, a healthy economy where there's housing demand, starts outpace closings. And you can see that that line reflects that over the generally the trajectory of this 10-year time period. But the numbers are really closely tied together right now, and that tells you that housing inventory is incredibly tight. So what we start, we close really, really quickly. So there's not a lot of finish and vacant inventory or spec inventory out there. Same thing on the resale side. So inventory just across the board is really tight, which pushes up prices. So you can see on the right-hand side, we kind of gave you a little bit more granularity about quarterly starts and broke it out by product type. Not a lot of condos in the third quarter that were started. And those that were started in the last year are predominantly in Larimer County. But you can see the big jump that we had in townhomes and duplexes, especially annual starts over the year, 64.5% jump in housing starts. And again, most of that is in Larimer County, but there are some that's starting to materialize in Weld County. And that generally this is an affordable position for builders to keep that first-time home buyer predominantly in a home because home prices have accelerated so quickly in Northern Colorado. And you can see closings have kept pace as well. So quarterly closings up 11% total, annual closings up 9%. So it's a good thing. And closings have actually accelerated in the last 12 months faster than starts. So again, that's kept our inventory really, really tight. So a little bit more about our quarterly starts. You can see on the left-hand side of the page here. Again, this is Larimer and Weld combined. Our actual second or third quarter starts are down 2%, but again, annually our starts are up. Our year to date on the right-hand side of the screen, you can see just taking the first 3 quarters of the year. That's even despite all of this disruptions because of the pandemic. We're still up 13% year to date. But I think it's again notable to look at our fourth quarter of 2019, right? We started about 846 homes. We had a big drop off. And I think there's a little bit of a hesitancy in the home building industry, in part because of capacity, in part because of the uncertainty about where 2020 was going to lead us. And we were also kind of dragging our heels a little bit because of maybe a spike in interest rates that we felt in 2019 as well in the summer. So maybe hitting the brakes is not the right word, but certainly took the foot off the gas. And so we had a lot of catching up to do in the early stages of this year, and you can see our starts jumped up. So if we just did the exact same number of housing starts in the fourth quarter of this year as we did in the fourth quarter of last year, which is 846, our total 2020 starts will be up 11%. We actually think it's going to be higher than that because, again, we've got this big backlog that a lot of the builders have, and they've got to get these homes started. So as long as the weather cooperates, the supply chain cooperates, we're going to get more foundations in the ground in the fourth quarter. So we'll probably be up 12, 13, 14, 15% in some scenarios at the end of 2020 for housing starts in northern Colorado. So hang on to that, and I'm going to come back to that as we talk about our forecast. A few more slides here when it comes to taking a look at the differences between Weld County starts, which is on the left here, versus Larimer County starts, which are on the right. So one of the reasons why Weld County starts went down, remember it was down 6% annually, it's down 20% in the third quarter alone, is because of that quick drop that we had in more affordable product. So it's pushing to higher price points. And again, there's not a lot of attached product yet in Weld County to sort of fill that gap that's materializing. Whereas Larimer County, it's a little bit more spread out around the price points. But the meat of the market for Larimer County is that $400,000 to $500,000 price point, which are up substantially, but there is more attached product that's sort of filling that first-time home buyer void that is starting to materialize in northern Colorado for single-family detached, particularly in Larimer County. So, and again, some of this is capacity issues, just sort of running out of lots. Like we had some really great successful projects in Weld County, like Severn Shores, for example, that was incredibly successful, and it took a while to replace that product with Hunter's Crossing, which is done very well and kind of in that same price point. But we sort of gap out in terms of lots and replacing that project or that same price product in Weld County. So again, we think that that's going to actually bounce back up in that 300 to 350 price point as more communities come online as we're tracking. Okay, and then lastly, lot supplies. So, we can say all we want about really high demand and housing starts we anticipate are going to go up, but to us, it all comes back down to capacity. Do we have the capacity to do it? And forget regulatory pressure and cost just for a moment, because those are other factors that contribute to lot supply. How difficult is the entitlement process? Do we have access to water? Can we get water? Water prices, as you all know, have gone up dramatically in northern Colorado at a much faster rate than the Denver metro area. So that all relates to how many lots we can deliver into the market. So it's still very tight in northern Colorado, about a 19-month supply in Larimer County. You can see it stayed very flat as we're trying to start more homes. It's even tighter in Weld County, a 16-month supply of lots. It's really never been that tight. And remember, Weld County used to be kind of the poster child during the recession of an excess supply of lots, just dormant communities sitting out there. Of course, we've long chewed through those, but it takes some time and it's more costly now to get new lots delivered. So again, we could say all day long that housing demand is out there and we can start more homes, but really can we? It really comes down to delivering lots at an affordable price to keep homes getting built at an affordable price for the consumer. So this is the big challenge for the home building industry in northern Colorado. So looking ahead, and some of you may have seen us, we've developed these scenarios, and these are kind of older scenarios that we had developed in kind of the early stages of the summer, maybe the middle of the summer. And each one of these, and we really talked to all of our clients about creating these scenarios for their own internal operations, because I think we all figured out pretty quickly when we had to reforecast and re-estimate what 2020 was going to look like at the beginning of April, and then had to revise that revision and reforecast that we did again in May and June, because the market was moving in such a dramatic fashion. It was really hard to kind of pinpoint an accurate forecast. So we decided, let's just come up with scenarios, because so much of this information that we're dealing with operates independently from one another, whether you're talking about health, government, economy, housing, but also are intertwined with one another. So for example, we came up with scenario one, kind of best case scenario. This could happen to the housing market if certain scenarios play out. So there's no second bounce, for example, in the number of cases. You could see that top line there. Well, that didn't happen because we're in the midst of a huge surge right now. We also said testing measures available for all and a vaccine available by or before the end of the year. I mean, really positive news that's coming out that the vaccine is going to be available. It's going to start to be distributed by the end of the year, and then throughout the January, February, March, and into the spring of next year. So that's all great. But then it comes down to like government restrictions about restaurant capacity. How do schools reopen? As I mentioned at the earlier part of my presentation, my wife's teaching from home for kindergarten. So kindergartners can't function on their own independently. They need parents to stay home with them. What does that do to productivity at work? So really challenging to get people moving again into their full-time jobs. So we had said in scenario one that all of that was going to work itself out. Kids are going to be allowed to go back to school again. Large gatherings will be able to happen again. Obviously, we're not there. The economy, this is sort of thumb up in the air kind of stuff. So would we drop below an unemployment rate of 6% by the end of the year? It looks like we've done that. Initial unemployment claims kind of ease back down a little bit. Oil prices stabilize and maybe actually go back up, for we've got some new investment again and new drilling in northern Colorado. Unlikely to happen in the short term. Stock market stabilizes. Obviously, it's done that. Retail spending stabilizes and accelerates back to pre-pandemic levels. In some ways, it's done that. Grocery spending, retail spending, obviously have gone up. Other parts of the retail market have gone down. And then housing, our model homes, again, allowed to stay open. Does the resale market come back? Does listings stabilize? Do home prices stabilize? So if all of that happens in kind of this scenario one, and again, this is a little older that we're looking at, we thought that the market would actually rebound and go up by 10%. And that's kind of where we're at. Remember, annual starts are up around 11% potentially at the end of the year. It'll probably be more than that, up to maybe 15%, because the home building industry is really kind of leading this economic resurgence. And then we went through scenario two. So just take all of those that I listed, and it's just a little bit worse. So there's some of what we're in the midst of right now that's still in scenario two, like schools that have shut down temporarily and had to go virtual, businesses that have had to sort of shutter again, and particularly restaurants. Travel still isn't back. There's no large gatherings that are still taking place. So this, we decided, well, if this occurs, kind of the scenario two, we're going to be plus or minus 10%. I mean, really hard to figure out what happens to the housing market. And then there's sort of the worst case scenario. Totally shut down again. Unemployment spikes back up. The initial unemployment claims start to spike back up. We start to see foreclosures work their way into the marketplace as the forbearances start to unwind themselves. The resale inventory starts to climb back up or stay incredibly tight because fewer people are putting their homes on the marketplace. So we haven't gotten there, and the stock market falls apart. And but I think it's worth noting that maybe you come up with your own scenarios in your own business. I think this is a worthwhile exercise that we know a lot of our clients have done. But the home building industry, one of the things that I'm so impressed with this industry and why I love this industry so much is it's so resilient. I mean, I think it's a great case study that we can all look back on back in April, what this industry did very, very quickly under unbelievably unique circumstances and really challenging circumstances that nobody had ever faced before. And they did it in a matter of days and weeks to pivot let's say online virtually, make sure all of their on-site staff was safe and following protocols. And meanwhile, trying to keep their model homes open by appointment only, keep their crews building homes. I mean, just unbelievable what the home building industry did. So if we have to go through that scenario all over again, if we have to shut down again, the home builders know how to navigate through this because of the lessons learned this past March and April. And the home builders are wired to kind of keep moving. And I think Robert talked about this a little bit earlier in his presentation about how sales have still accelerated so quickly and far outpaced. There's such a big gap between sales and actual starts on the ground. The builders are taking those sales when they can get them. We'll figure out the challenges associated with that as they come up, whether that's supply chain issues or pricing issues. So we sign a contract, but suddenly lumber prices go back up, or we can't get the cycle time to get those homes built starts to get extended out a little bit because we can't get all of the suppliers to get their product into our homes. So there's carrying costs associated with that. So, there are risks involved with that, but the home builders are just wired in a way to we got to take this demand while it's out there and it's healthy. We'll figure out the rest later. And again, it's such a resilient industry, and that's why I love it so much. I think we'll get to the end of the year here and we'll be up 10 or 15% for housing starts. And we've got this really strong backlog that's going to carry us into the beginning of next year. But totally agree with Robert and what he said, especially as it relates to Northern Colorado and the Denver metro area. We see the rate of growth that we've had over the last several couple of quarters is probably unsustainable because of home prices, because of capacity issues, and because of the economic uncertainty that's still out in front of us. Even though the home building industry is incredibly optimistic as it stands today, but they all know they've got an eye on the future about there's things, the rug could get pulled out from under us at a moment's notice with where this pandemic is today. So we've got to be, I think, really sensitive to that. So challenges ahead. We've gone through pretty much all of these. Water cost and availability is a big one. The oil and gas industry in Northern Colorado is a huge one. Entitlement timelines, regulatory pressure is a big one. Managing those costs and trades is really difficult. But again, the builders kind of know how to do that. Lot supply is really tight. And the economic uncertainty, and just with the pandemic, again, to me, that overrides everything that we've been talking about. And then what do we have going for us? Robert talked about this too, just the demographic shift that's taking place, low interest rates, the shift of the mind share of the buyers moving from the resale side to the new home side. New home builders can deliver, a clean new house with new technology, and in particular kind of health considerations that the existing home market can't. More people, I think, are sensitive to the type of home that they're buying, and they're looking for maybe better air quality now than they weren't a year ago. Or let's say the particulates that are spun off from the materials that go into a home, that's important for air quality as well. So the home building industry, was already starting to do this anyways, but I think the pandemic really accelerated the consciousness of the buyer about what am I buying here? What do I really want in a home here? And new home design trends are, I think, reflecting that. Again, it was already happening, but the pandemic really accelerated the need for working from home. As I told you, my wife is today. I have a son from college who's home as well, doing his classes down in the basement. So, how do we navigate that? The home that we've been in for 20 years doesn't really fit very well with those scenarios. So we've got this healthy backlog. We've got some push for demand coming out of the Denver market for space, for affordability, and I think that's going to feed well into Northern Colorado for the long term. And we've got really healthy underlying economic strength of our local market, certainly heading into the pandemic. The migration numbers that we've showed in presentations before to this group have been incredibly strong in Northern Colorado, and that's continued to serve us well. So again, there's a lot of optimism in the home building industry about where we sit today, particularly given what we've just gone through, but still some uncertainty about what the overriding impact of the pandemic in our local economy is going to look like. That's all I have. Certainly feel free to reach out to me by calling me or emailing me with our new email address. It's no longer metrostudy.com, but jcovert@zondahome.com. So I'm going to kick it back to you, Dan or Nikki, if there are any questions. So appreciate you guys having me.
I guess I've popped back up. So hopefully I put a note in the question and answer box there. So if anybody has any questions, please type those in there. Hopefully we can start answering some of those. Not sure if Robert's going to get back on here. Oh, there he is. He's coming back on. So
He's taking notes.
yeah.
Sorry, that was great stuff, John.
I was doing the same. So so a couple of questions I have. I'll throw a couple in just so at least that way we've got something to discuss here for a moment. You both had noted that the current lumber prices have begun to stabilize, level off a little bit, and one of the reasons for that is potentially a drop in the tariff rates from about 20% to 9%. What do you guys think is going to happen in the next 6 months to year on those lumber prices?
So I think on a composite index measure, which is that dollar value per thousand board feet, we're right around 550 right now. Futures markets suggest that we should see it fall to 500, 450. That's still above where we were in April. I think the reduction in the tariff rate will help. It won't cut prices by 11% because we only get about a third of our lumber from Canada. So the impact is more like a 3% impact. The real challenge is just getting the sawmills back online. And that's something we've been waiting for a while. I track monthly, how many people are working at the sawmills. It's begun to creep up. It's still down about 1,000 workers. But I think we're going to see domestic production really stabilize. And that's going to help. The challenge is what we said before, which is, we put a lot of focus on framing lumber, but OSB pricing remains well elevated. And everything that we hear nationwide is that it's just taking longer to get building materials. And so that's going to extend the construction process.
Any input there, John?
Nope. Robert knows that material way better than I do.
Okay. One of the other notes that John, you had brought up, water costs, increased water costs in northern Colorado. What do you two have for insights in that? What do you think is our futures there and those sort of things?
Yeah, that's a really tough thing to answer. It's a bit of a moving target in northern Colorado because it's tied in some water delivery mechanisms to what the current share of water is, the price per share of water, because there's not a lot of public utilities up there. Let's say, for example, like Denver water down in the Denver metro area, or Colorado Springs water down in Colorado Springs. So it's a bit of a moving target. And I think the risk, though, is that as water prices have continued to accelerate and land prices have continued to accelerate in northern Colorado, the challenge is that obviously translates to a higher home price, and throw on top of that, fee increases, permit fee, impact fee increases that kind of been across the board for most of the local jurisdictions. Suddenly the price of homes go up pretty dramatically, and household incomes are different in Weld County than they are in Larimer County, again, because of the job mix. So home prices have been accelerating very quickly, where household incomes have been, again, accelerating in northern Colorado, but not to the degree that home prices have. And home prices in northern Colorado probably have been land prices and water price increases have probably factored into the home price increase in northern Colorado more so than any place along the Front Range of Colorado, at a faster rate that the typical household can't afford. And I think that's a bigger risk for northern Colorado, in terms of saying, again, well, there's plenty of demand out there for housing, but do we have the capacity to do it? And again, this comes back to regulatory issues, water prices, land prices.
And that sort of brings up the election, which I don't think either one of us talked a whole lot about. You know, if we think about regulatory policy, legislative policy, and say monetary policy is sort of the key things. Monetary policy, we're not going to get much change. So our interest rate forecasts remain fairly stable. We got Janet Yellen coming in as the Secretary of the Treasury. She was the Fed chair. She and Jay Powell are on the same side, and they're both doves, which is fantastic for the home building industry. We take the NAHB senior officer team to meet with the Fed board, you know, contacts throughout the year, and they're right where we want them to be in terms of monetary policy. Legislative policy, I'm going to go ahead and say, you know, we think the Republicans are going to control the Senate. So tax policy and spending policy, there'll be some more stimulus, but I don't think we're going to see a big rollback of the 2017 tax cuts. Maybe at the high end, some trims, but not a whole lot. So it's regulatory policy that really changes after the election. And I think we got to watch two key areas that are going to be really important for construction, because they're areas where progressives in the Democrat Party really want a lot of change. That's what the Department of Labor looks like, and what it's in terms of environmental policy. So waters of the U.S. rule, you know, what land has to be subject to a clean water permit, things like the silica rule will be taken a look at. And then on labor policy, independent contractor misclassification, the joint employer standards, all these rules that we remember back from 2015 and 2016 are going to be readdressed. So they're announcing who's going to be these you know, cabinet members right now. Let's watch who becomes the next head of the Department of Labor and who chairs up some of these environmental policies, because they can act through regulatory policy and they don't need Mitch McConnell to give say-so to proceed. And that's an area where I think we could see those supply constraints that John has mentioned having an impact in terms of aggregate home building production in 2021 and 2022.
Hey, Dan, if I could jump in with a question for Robert. Sorry, Robert, to throw this out at you. You know, a couple of things out of the Biden campaign that have been mentioned are 1031 exchanges, and then the $15,000 first-time homebuyer tax credit. You know, I'm wondering if you could talk a little bit about how you guys are approaching trying to understand both of those potential policy measures. Both would have obviously a direct impact locally for housing, especially when we're talking about land constraints here in 1031s. A lot of land developers use that as a mechanism to throw off into new community development. You know, I look at the potential tax credit as, you know, usually that's a way to spur demand, but demand isn't really the issue, it's supply. You know, we should try to figure out how to help all of the institutional rental home owners start to unloading some of their supply, and that would solve the problem right there, maybe.
Yeah, 1031 or like-kind exchange, that is the top tax policy that's at risk. So, you know, we got to watch those Georgia Senate elections. If the Senate were divided so that the incoming vice president gets the tie-breaking vote, like-kind exchange is at a real risk, and that will affect land development markets. It'll affect apartment liquidity and turnover and commercial real estate pricing, because that is a primary way that you generate liquidity in an illiquid market like real estate is the like-kind exchange rules. So I'm concerned about that, and the Biden team has said they would like to get rid of that for taxpayers of certain income levels. So I think that's the top tax policy threat. They have thrown out this idea of a $15,000 homebuyer tax credit that could be advanced or monetized. I mean, before I started as chief economist at NAHB, I spent a decade doing tax policy work. And so I spent 3 years working on the homebuyer tax credit, Section 36, back during the Great Recession. You know, we authored the first round of it back in HERA in 2008. I agree with you on the economics. We've got supply side concerns that I think trump, some of the demand side challenges. It wouldn't necessarily be a bad thing to have a home buyer credit, but if it couldn't be turned into a down payment at the closing table, it would, in the short run, mostly boost housing prices, because what we really need to do is increase supply.
Yep.
So, from an NAHB perspective, we're preparing a document right now, sort of addressing the supply side challenges. Hopefully that HUD will publish its review of some of the supply constraints, and it's at the local level where a lot of the aggressive policy work can be really done to make sure those regulatory burdens don't build up, and we can create additional lots. And hopefully then John's graphs will show growth and some of those lot supplies when we talk a year or two from now.
Good, thanks.
All right, good question there, John. We have a question from Jerry Runta. He's asking, what do you guys forecast for mortgage rates into 2021 and 2022?
So the slide that I showed you, we think those rates are going to go up. They're not going to go up as fast as the 10-year Treasury, but both rates are going to go up. I mean, I've been saying rates have been going to go up for about 3 or 4 years, so I'm sort of a dead clock on this. But I think rates are going to go up. But here's the important thing: I think the 30-year fixed rate mortgage is, for the next 2 years, going to remain below 4%. And the modeling we've done, we learned this, and John hinted at it in terms of late 2018, 2019, when we saw the market. It didn't stall, but definitely as we got to a 4.9% 30-year fixed rate mortgage, demand pulled back. Now, I'm not saying 4.9% still kind of the speed limit, because home prices have gone up during that period of time. So, I would say right now, if you see the 30-year fixed rate mortgage get up to about 4.5%, think back to what happened in late 2018. But I don't think that's going to happen for the next 2 years. And I think in part that's thanks to the fact that we've got a Federal Reserve that really is on our side of housing's the bright spot, housing's the engine, and where monetary policy creates growth.
All right, we do have another question from BJ Joe Honningmeyer, and they're asking, do you have projection on lot prices in the near future?
John?
Man, oh man, this is probably the number one question that we get from our developers, landowners, builders, and it is so variable from project to project. And again, water's a big factor, and especially in northern Colorado, when you might be in one water district on one side of the street, another water district on the other side of the street, and they're completely different variables that go into that water cost. So I will tell you that in the Denver metro area, we've had recent discussions about the new norm now, and these are A projects in A submarkets, is $3,000 a front foot for a lot. And that's an all-in price. So I remember 4 or 5 years ago, we were all shaking our heads at $2,000 a front foot for a lot. So for a 50-foot lot, it's $100,000. So now that same lot's $150,000. So it's pretty staggering to think where lot costs have gone. And again, this is because of the constraints in the industry. And it's not all regulatory pressure. It's certainly some of it. It's not all water. It's certainly some of it. It's also, it's just really challenging to get through the entitlement process. It just takes a long time. And there's more costs associated with that. So it's a riskier proposition. So it's a difficult process to get lots entitled, especially at a time when housing demand is growing so substantially and we're so undersupplied for housing, and we have been for the last decade, to get caught up. And so again, to me, it comes back to capacity, especially if you go from $100,000 lot 4 or 5 years ago to $150,000 lot cost. What's that do to the home price? Well, the home price is going to have to absorb that cost. So what percentage of your buying public can afford that increase in a home price? And that's the risk where I think most of the markets around the country are really stumbling into with just high home prices that are escalating beyond what people can afford.
And that's the risk in 2021, is buyers being priced out of the market, even as the labor market heals.
Yep.
So our home price forecast, we think prices will continue to grow faster than inflation. My expectation, we don't forecast lot prices because they are so hyper local, highly variable. You need your local experts like John to kind of really track that market. But my expectation would be that lot prices are going to continue to grow faster than inflation as we move forward, even as some of the potential demand shrinks at the margin.
So I'll throw a little bit on top of that. My question there then is, John, you had said in one of your slides that condo starts in this area were down about 62%. Do you see that gaining some strength and beginning to change, or what are your thoughts there? That becomes our low end market, basically.
That's right. Yep. And I think keep in mind that decline of 62% was a pretty small basis point. That sounds like a dramatic decline. It really wasn't, just because we're talking about pretty small numbers here anyways. I do think there's need for more condo activity, but the problem is we have a lot of construction defect liability issues still kind of working its way through the system here, particularly in Colorado. It was heavy hit with construction defect lawsuits, class action lawsuits that are still impeding some of that rebound in condo activity in Colorado. Now there is some of it. There's certainly demand out there for it, but I think that's why you've seen the townhome, duplex, paired product market really grow here in Northern Colorado at even a faster clip than we've seen in some of the Denver markets, because it's taking the place of what maybe historically could have been more condo activity. But I do think you're going to see more condos pop up. We're working on a couple of big projects that are going to include some condo activity as part of big master plan communities. So we're going to see more mixed use, higher density, more amenity rich communities come online in Northern Colorado. And we're excited to see that, because I think there's a market for it in Northern Colorado, whereas maybe 10 years ago, certainly 20 years ago, the market really wasn't there yet. It wasn't needed necessarily, and that's not what people were seeking, but we've had enough migration, enough housing demand, enough high home price appreciation that more density is going to be needed in Northern Colorado. So yeah.
And at a nationwide basis, a condo for sale multifamily is only 4 to 5% of multifamily production. So it's really low. It never really bounced back after the Great Recession. It could increase marginally, but what we think are the growth segments, at least nationwide, is the medium density to low density markets. So it's going to be tough in the 50 plus multifamily space, but there should be gains in that 49 on down to townhouse. And some of that isn't going to be for sale. It's going to be built for rent. So we do think that the single family built for rent sector right now, which is about 4.5% of single family starts, that's going to creep up to 5, 6, 7%. It's going to be concentrated in certain places with affordability concerns like California. But I'm kind of bullish on townhouse and light touch density, particularly low rise multifamily that doesn't have an elevator, doesn't have a lot of common space, because even after a vaccine, I think people are still going to be wary living in a 40-story building. And if you haven't been in one of those since March, whether it's residential or office, it's a different experience. And it has chased some people away.
Just hold your breath the whole elevator ride up.
Something like that. and dream of a single family house in the suburbs. Yeah. I'm in a medium density environment in Arlington, Virginia. I go into DC every once in a while. I'm happy to be in my townhouse community, even though I wish my basement was larger.
Absolutely. We have one more question on the board from Ted Leidy here, our Colorado Executive Director. He's asking, how real is the suburban demand due to COVID in Colorado? If it is real, do you both believe that it will sustain beyond COVID, and what will it mean for condo demand?
I've been really aggressive on this because I feel like I've been fighting with some of my peers at Zillow and other places since June on this. It's real. We see it in the construction data. It is going to roll back in part, but there is going to be a persistent effect. And it's not going to be because you've got workers in New York City that are moving to Northern Colorado or Wilmington, North Carolina to work full time. What it's going to change, and because we've accomplished about 10 years of change in about 6 months, is that not everyone's going to be required to go in the office 5 days a week. And we think that for about 40% of workers, 60% of that total, so a segment of a segment, are going to go in only 2 days a week, which expands their acceptable commute. So there's going to be some persistent effect. Now, where demand's going to roll back first, though, just what we were talking about, townhouse, medium density, and then some people who are able to live further out in the exurbs, particularly younger households who want to be able to buy a home. And so it's a partial effect. It's going to persist. And as John said, as you move to those markets, home building is a greater source of share of supply. And that's great news for home builders.
Yep, totally agree. Yes, yes, yes. There's some systemic change to how people are working and living at home that I think is long lasting. So I think to answer your question, Ted, we were already starting to see some of this anyways, particularly in the Denver metro area. As you know, go out to DIA and that surrounding area in Aurora and in Adams County. Big communities were already coming online there, but their rate of growth has really accelerated. And even in the next ring out, the true suburban periphery, in really affordable communities where you got to drive a long ways to get out there, we've seen a pretty strong uptick in sales activity. And these are places that were sort of out of reach previously, but people want space. And we've interviewed a lot of local brokers over the last 5 or 6 months, especially ones that do a lot of work in kind of the urban core area, downtown Denver, like the central business district. And they're like, yep, it's been a mass exodus. So the months of supply of existing high-rise condo listings has doubled in the last couple of months, where resale inventory has been declining across the board. So it's run counter to everything else that we're seeing in the resale market. So people want out of their high-rise condos and they are trying to figure out how to get out of it. So again, I do think that there's some systemic changes afoot here, and we may see eventually in the short term people come back into the cities once the vaccine's in place and they're feeling a little bit more comfortable. I think that'll inevitably happen, but probably not to the degree that we saw the rush into the urban core in some of our cities over the last decade. It's been really substantial. So I think the suburban markets are here to stay for the long term, for sure.
Good answer. I don't have any other questions. Do you guys, either of you, have any other questions or thoughts at this point?
I've got one for Robert. Will the Washington football team win the division and make the playoffs?
So I hate to say this in Colorado, my wife is a Kansas City Chiefs fan. So,
never mind.
So my kids are Washington football team fans, and I'm an Ohio State Buckeye, but I think they might. So we'll see. Somebody's got to win the NFC least, but
okay,
it'll be fun to watch.
Good enough.
Well, I appreciate both of your time today. Hopefully everybody that's listening has gotten something out of this. I know it's always good for me to sit and listen and think about what is happening outside of my little box. So I appreciate both of your insights. So I think that we've got both of your email addresses and all of that information. So if anyone is looking for more information, please send an email, call, all those things. So thank you both, and everyone have a great day today.
Great. Thanks, Dan.
Thank you.